The Connecticut Business and Industry Association's Economic Summit and Outlook 2020 is underway today. Joining us from Hartford, Connecticut is Brian Chung, and he's joined by Boston Fed President Eric Rosengren. Brian?
Hi, good morning. We're here in Hartford, Connecticut, where President Rosengren, again, the head of the Federal Reserve Bank of Boston, just made your first remarks for 2020, providing an outlook for the U.S. economy. So, in short, what do you expect for the U.S. economy in 2020, and what should that mean for rate policy going forward?
Well, it's a relatively positive outlook. We have the economy that has grown pretty well over the last year, despite the problems with trade and the global slowdown. I'm expecting that we're going to see growth right around 2% over the course of the next year. That's a little bit stronger than the productivity of the overall economy, the growth of the overall economy. So that would entail a tighter labor market, a little bit lower unemployment rate, and a little bit pickup of inflation. So we'd see inflation closer to 2%. Overall, the outlook is good, and it's basically a soft landing, which means that we don't need to do very much at all on interest rates as long as we have that kind of outcome.
And that's what we saw from the SEPs, which were the forecast projections from Fed policymakers in the December meeting over what we might see in 2020, which was basically holding steady at the current range of 1.5 to 1.75%. What would you need to see to then change that baseline if you think we've hit that soft landing already?
So the question is whether there are risks to the forecast. So that's our most likely outcome, or our modal forecast. And I think it's a pretty good modal forecast. But there are things that could go wrong on both sides. On the weaker side, if we were to see a pickup in trade concerns or more of a global slowdown, we've seen some geopolitical concerns of late, and those could potentially slow down the global economy in a way we're not anticipating. On the more positive side, the risk there, I think, is from financial stability concerns, that we start seeing exuberance in financial markets, we start seeing real estate prices getting ahead of themselves, and as a result that we end up having to have a correction down the road. So I think we have to be aware of the risks on both sides. Last year we were primarily focused on risks on the downside. We should also be focused on some of the risks on the upside.
So on the risks to the downside, you mentioned two components, U.S.-China trade, but then just broader geopolitical concerns. It seems like on one front, U.S.-China trade, we have the phase one deal signing supposedly this week. But then on the geopolitical risk, there's been the flare-up in the Middle East between the U.S. and Iran. Are those things kind of net positive, net negative right now? And would you need to see a development on either of those fronts to also maybe then change your outlook for where rates should be?
Yeah, I would say in the middle of last year, we had much greater trade concerns than we do right now. The fact that we have, or are likely to have, a phase one agreement is certainly good news. I think it's far from a complete trade agreement with China, or for that matter with Europe either. So I don't think we're out of the woods in terms of some of the trade concerns. I do think they've moderated relative to where we were maybe 6 months ago. So that's net positive.
Mm-hmm. But on the U.S.-Iran front, it seems like financial markets have been kind of a little shaky on that. Is that something that you're just kind of watching right now, or is that something that you would expect to maybe get folded into some of the Fed debates as we head into the first meetings of this year?
The geopolitical concerns are always things that could happen, but to be honest, we've seen oil prices move a bit, but not enough to really impact the economy in a significant way. And the United States is not nearly as reliant on the Middle East as it used to be in terms of oil. So I would say on net, I think it's unlikely that issues with Iran end up deterring the economy from continuing to do pretty well. But it remains to be seen. If we had a broader problem than what we've seen to date, then that would be something that we'd have to worry about.
So let's talk a little bit about the focus of your speech here today in Hartford, which was about the labor market and maybe inflationary pressures possibly running away if that were to be the case. For right now, you say that you think that inflation is pretty okay where it is. In fact, you said it was a basically almost ideal situation. We had a jobs report last week, 145,000 jobs added, unemployment stayed at 3.5, wages only up 2.9% year over year. What was your reading on that recent jobs report for the month of December?
So I was a little, in terms of the payroll employment and the unemployment rate, I thought it was a pretty good report. In terms of average hourly earnings, it was weaker than I expected. Average hourly earnings have been trending up, so wages have been trending up over the last couple of years. So it's a little bit of an anomaly. I don't take too much information from just one report. I would expect that with tight labor markets, there's really no reason for wages to backtrack. And I would expect over time that we'll see upward progression in wages.
Now, you said it doesn't backtrack, but we did see that wages year over year were, getting up as high as, I think, 3.4% in February of last year. Again, 2.9% for December. So you think that the wage Phillips curve will continue to maybe bid prices for labor up through 2020? And you mentioned that the neutral rate you might expect to be around 3%. What's kind of your forecast for what that might look like in 2020?
So the unemployment rate's quite low by our normal standards. We're at a 50-year low. We particularly see it in New England, where most of the New England states, particularly north of Connecticut, have unemployment rates that are below 3%. So when I talk to businesses, one of their biggest concerns is how they're going to attract enough labor. And the way you attract more labor in a very tight labor market is you offer higher wages. So I think one of the concerns would be that if labor is too tight, we start to see wages going up more rapidly than people are anticipating and more rapidly than productivity increases. So wages going up because productivity is going up, that's not a problem for the economy. Wages going up when productivity is quite slow, that is potentially more of a problem. Businesses either have to have lower profits or they have to raise prices more quickly.
Right. So when we talk about the labor market, it seems like there's a semantic question about whether or not you should call it a tight labor market, a hot labor market, or maximum employment. If you've described the economy right now as almost ideal, where do you see the labor market? Do you see it as basically at maximum employment?
So maximum employment, I would say that we have very tight labor markets, very strong labor markets right now. We have seen wages going up. They're not going up more rapidly than inflation and productivity, so I don't think it's a problem for the economy at this stage. But if wages were to continue to drift up, at some point that would start translating potentially into more inflationary pressures. So I view that as a risk rather than a likely outcome, but I do think that we have to be attentive to risks.
And lastly, you opposed the 3 rate cuts last year. You're still a participant of the FOMC, although you rotated out of being a voter as we flip the calendar into 2020. As we look back, you've flagged financial stability risks as a result of maybe easier monetary policy. I know that monetary policy operates on a lag, but have you seen any of the effects that you've been warning about in commercial real estate, for example, in office leasing business models like WeWork in the economy so far?
So I do watch real estate markets quite closely. They're interest sensitive, and they tend to be an asset class that gets the economy into trouble if they end up reversing quickly. And so I am focused on whether residential real estate prices are starting to increase more rapidly and whether commercial real estate prices are increasing more rapidly. They have been going up a little bit faster than you might have expected, and I think that is an area that we should continue to watch to make sure that the accommodative monetary policy that we have right now doesn't start causing imbalances in the economy that become a problem.
Once again to the nitty-gritty, because obviously the balance sheet is something that's kind of difficult to explain to some people. But regardless, we've had a growth of $60 billion per month on the balance sheet itself, short-term Treasury T-bills. But then we've had over $200 billion offered through the temporary operations at the New York Fed. In the aggregate, with the 3 rate cuts that we got last year, what has been the effect of growing balance sheet policy at the Fed?
So I view the interest rate policy a little bit differently than the balance sheet policy. So the interest rate policy was clearly that we wanted to ease, in part because we were worried about the trade concerns, in part we were worried about global weakness. And so that was intended to offset that concern. I would say in terms of our balance sheet, that wasn't really meant to be anything more than a technical adjustment. So we don't know exactly where the demand and supply of reserves actually is. And one of the reasons we don't know that is a lot of the bank regulations have changed pretty dramatically. And so we were shrinking our balance sheet coming out of the financial crisis. And we didn't quite know where we should be leveling off and then growing our balance sheet. And in retrospect, it looks like we shrunk the balance sheet a little bit too much. Reserves got a little too tight. And so we've eased up on that. So I view that less as a monetary policy action to stimulate the economy and more as a technical adjustment to make sure that we were able to hit our Fed funds target.
And that's been pretty clear from Chairman Powell's press conference saying this is a technical adjustment to keep the Fed funds rate in range. But if the calibration was kind of trying to figure out where the proper level of reserves is, then it's also a question of figuring out what the estimate should be when the Fed at some point were to stop the expansion. So what we know is that I think the purchase of $60 billion is going to happen per month through at least the first half of this year. But do you have an estimate? Have other policymakers started trying to figure out when to maybe stop the further expansion of the balance sheet at this point?
So I don't think it's a question of stopping so much as slowing down. So our balance sheet kind of grows naturally. One of the reasons it grows naturally is that there's more currency in the world, U.S. currency. And so you'd expect our balance sheet to grow with the amount of currency that people demand. So that's going to continue. So it's not like we stop growing the balance sheet, it's just that we grow it less rapidly. And so I think in the next 3 or 4 months, we'll get a better sense of what the supply and demand for reserves are. And at that point, we can make a decision about when we want to grow the balance sheet, just consistent with the liabilities.
So shifting back to the conversation on the labor market, the labor force participation rate stayed the same between December and the previous report, 63.2%. Some have pointed to that as an example of there being slack in the labor market. But your presentation might suggest that if we were to be close or relatively close to maximum employment, that maybe we have pulled in all that we can pull in so far. What's your view on that? And do you think that given where the labor force is right now, that the Federal Reserve should not be further accommodative through 2020?
I think we're appropriately accommodative now, and I do have concerns about making sure that we adjust the risks, given how accommodative monetary policy is. I don't think there's much slack in the labor market, to be honest. I think that we have tight labor markets now. That's why we've seen wages gradually going up. That's an indication that labor markets are tight. Whenever I talk to businesses, their first complaint actually is that they have trouble finding labor at the prevailing wage, and that they've been increasing wages. So I think there's plenty of evidence that labor markets are tight. You are seeing people switch jobs a little bit more frequently, and I would expect that if we continue to be at this level of the unemployment rate, that we would over time see wages continuing to go up in a way that might go up faster than productivity, which would be more inflationary.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.